And I think I'm going to start off the second video. Well, it's going to be the only video. It's not really starting off. My second video is going to be from Wolf Street, I guess is what I was trying to say. Wolf Richter again. Considering I just talked about freaking Snapchat, down to $13.40. That turd is such a dead man walking. I don't even know how it's even alive these days. Having said that, the markets overall, generally speaking here, markets relax merrily on a powerful time bomb, says Wolf Richter. Magnitude unknown, but huge. Brokerages push it to new heights. And the central banks are pumping. Hi, I'm the central bank, and together we're going to pump you up. Stock and bond markets leverage is everywhere. Market leverage is everywhere. Some of it is transparent, such as New York Stock Exchange margin debt, which was $539 billion as of the June report. But the hottest form of stock and bond market leverage is opaque, offered by financial firms that usually don't disclose the totals, securities-based loans, SBLs, or shadow margin, because no one knows how much of it is there. But it's a lot, and it's booming. As I hear this right here, I can't help but to think back to the days of AIG. Remember? You got to bail out AIG because they need to bail out the big banks, the too big to fail banks, because their derivatives have exploded and nobody can cover each other because the financial damage is so great. So we're all going to the insurer, which is AIG, who doesn't even kind of have enough money to fix even one of these banks. So we need to bail out AIG too. That's kind of what I think about when I hear this shadow margin. No one knows how big it is, you know. These loans can be used for anything. Pay for tuition, fix up that kitchen, or fund a vacation. The money is spent, the loan remains. When security prices fall, the problems begin. FINRA, the regulator for brokerages, doesn't track this shadow margin, nor does the Security and Exchange Commission. Both, however, have been warning about the risks. No one knows the overall amount of this shadow margin, but some details have been reported. A few bullet points. Morgan Stanley had $36 billion of these loans on its balance sheet as of the end of 2016, which is up 26% from 2016, early in 2016, and more than twice the amount in 2013. Here's the next one. Bank of America Merrill Lynch had $40 billion in these SBLs on the balance sheet at the end of 2016, which is up 140% from 2010, that is. UBS and Wells Fargo also have made billions in such loans. People familiar with those banks told the Wall Street Journal. Raymond James Stifel Nicholas, they're all doing it, he says. Fidelity used the fund to fund its own SBLs for its clients, but 3 years ago partnered with US Bancorp. And finally, even the little ones are trying to get a slice of the pie. In April, robo-advisory startup Wealthfront, with less than $6 billion, announced that it would offer SBLs to its clients. And now, the vampire squid. Goldman Sachs, which has been offering SBLs to its 12,000 super wealthy clients through its private banking unit, accounting for more than half of the unit's $29 billion in loans outstanding, according to the Wall Street Journal, announced on Thursday that this wasn't enough and that it is partnering with Fidelity Investments to spread these loans far and wide. Kind of like spreading a dirty diaper on the walls, far and wide as I can do that. Not that I would know anyone who would take a dirty diaper, dump it on a wall, and then smear it. So don't ask me where the hell that came from, because I'm not going to give you an answer. The effort to lever up investors' portfolios occurs after an 8-year bull run, with stock indices hopping from one all-time high to the next, even as the economy has been growing at a dreadfully slow pace, and even as corporate earnings have mostly gone nowhere for years. Since July 2012, the trailing 12-month adjusted earnings per share of the companies in the S&P 500 rose just 12% in total. Over the same period, the S&P 500 index itself soared 80%. These adjusted earnings are now back where they'd been on March 2014. 3 years of earnings stagnation. However, over the same 3 years plus, The S&P 500 index, of course, has soared 33%. As earnings have stagnated while stock prices have jumped, the price-to-earnings ratio for the S&P 500 companies has soared from 14.8 at the beginning of 2012 to now 24.8, and bonds have seen an enormous bull run too. Again, the price-to-earnings ratio is astronomically out of sync with reality, just like the prices of their stocks, or just the stock market generally. Which again, I mean, obviously if the price-to-earnings ratio is off the charts, then you know the stock prices too, but point being, they're both super high and outrageous. I mean, you could theoretically have price-to-earning ratios high, but when you look at the actual price of the stock, still not say, well, that's absurd. You know, Snapchat, $30 billion. Snapchat. I'm going to beat that horse, Snapchat, until it's dead. Every video I can possibly do when I find that nonsense, I've got to do a video on it. Because this is beyond absurd. Is this how desperate people are now? Chasing yield, chasing interest? I got to go anywhere. It's just, I don't care if it's a pump and dump. I don't care if it's a freaking Enron. Just put my money in there and let's see the return. I mean, that seems like that's where everything's at right now. It is at these precariously high levels of the markets that brokerages go into hyperdrive to push shadow margin on their clients, using inflated securities as collateral. If markets decline, brokerages start making margin calls, and investors will be forced to sell the securities into a falling market at the worst possible time, or else the brokerage will liquidate their portfolios. Investors could lose every dime in their accounts and might be personally responsible for the remainder of the debt. And I just got a question. Just kind of came into my little mind here. You know, suppose there's going to be another MF Global John Corzine event sometime in probably the not so distant future, do you? After 8 years of a bull market, no one is thinking about risk anymore. Goldman Sachs will offer these SBLs to about 6 million accounts managed by 3,850 brokers and wealth managers that use Fidelity's technology, though they will not be available to Fidelity's own retail brokerage or wealth management clients. Andrew Kaiser, head of Goldman Sachs Private Banking, told the Journal that this partnership with Fidelity is just the first of several. What's in it for the brokerages? SBLs are a source of revenue that replaces some of the revenue brokerages lost as they're moving away from charging commission on trades to charging fees and assets under management. When clients need money, they normally sell some securities and withdraw the proceeds from the account. This would lower the asset balance of the account and therefore the fees for the broker. So brokerages encourage clients to leave their assets intact and add a big loan to the account. This keeps the asset-based fee intact, and the brokerage also earns interest income on the loans. Everyone at the brokerage benefits from the deal. Well, that everyone at the brokerage, maybe not you, because you're not at the brokerage. Your account's at the brokerage, just like it was at the MF Global brokerage. And you thought you had some digits in the account because it was a segregated account. You didn't know that John Corzine himself was sticking his greedy hands in there, stealing your money, betting on the market, lost the bet on the market, and then went belly up and told you pissed off, sorry about your luck, your money's gone. And it's gone. Several Merrill Lynch brokers said they have asked long-standing clients to open securities-backed lines of credit to help them hit bonus hurdles. We need someone to throw us a freaking bonus. Go ahead and open up some of these accounts. Assuring that clients wouldn't need to use it or pay any fees for opening it, Merrill brokers receive ongoing payments for getting clients to tap credit lines, and those loan balances contribute to year-end bonus calculations, people familiar with the matter said. Brokerage executives have said that the longer a client has one of these loans tied to their account, the more likely they are to use it. We are dramatically pushed to put these on all of our client accounts. Up. Bug. On the screen. Not no more. Did you catch that? We were dramatically pushed to put these on all of our clients' accounts, said Stephen Dudash, a former Merrill Lynch broker who has been managing his own investment advisory firm since 2014. Whenever you're product pushing, it's not in the client's best interest. Quick look surprised. So what's in it for the clients? Clients get to pile on low interest rate debt and huge risks. including the chance of losing more than all the assets in the account if push comes to shove in the markets and their collateral value gets crushed. They will have to sell into a crash at the worst possible time, and even after they sold all their assets, they still might owe the broker, and the broker will go after them for the remaining debt. As the journal explains, these arrangements are structured to benefit the brokerage, with the client shouldering virtually all the risk, of course. And these loan products are often pushed without regard to whether clients even need them, they add. You know what's nice about cryptos or holding your own physical metal, precious metals? You know what's nice about that? None of that stuff will affect you. You're not going to get a margin call. Then again, I do believe there's one or two exchanges that allow you to play with the freaking cryptos on margin. How stupid. So therefore, theoretically speaking, on those one or two exchanges, it could happen. But again, when you own the crypto, it's in your wallet. You're not playing on some stupid exchange, trying to whatever. You're just sitting there holding it. I want to buy these tokens. I hold them. I want to buy a new crypto, whether it's Litecoin or Ethereum. I want to hold it. Doesn't matter if the price goes up or down. You're not getting a margin call. You just ride it out and wait for the price to rebound. Anyway, so that's it for this one. Take care.